Okay, let's dive right in. We're unpacking something truly remarkable today. How Ghana managed one of the most, well, stunning currency comebacks I think we've seen in recent memory.
It really is quite the story.
Yeah, well, you're talking about Cedi. Back in 2022, people were calling it the worst performing currency on earth. Just think about that.
Dead last, effectively.
Exactly.
Yeah.
But fast forward to mid-2025, and it's somehow become the best performing currency. It surged nearly 50% against the US dollar.
Which, I mean, that left economists pretty much speechless, right? And investors are just scrambling.
Totally scrambling. So the big question is, how? How does a currency that was just crippled by debt, inflation, utter panic, how does it suddenly become the strongest?
That's what we're digging into.
Right. So for this deep dive, we're going to unpack the sequence, these deliberate connected choices that made this, well, this economic miracle actually happen. And we're pulling insights straight from the source materials we've looked at. So let's set the scene first. Ghana, 2022. The Cedi wasn't just weak, it was an absolute free fall.
Dire situation.
Dire is the word. I mean, our sources mentioned farmers watching their cattle die. Just die.
Yeah.
Because there was no grass, no water.
Devastating.
And if they were lucky, maybe they could find a butcher for a dying cow, make a few dollars. Gives you a sense of the human cost.
Absolutely. The currency was just broken, debt, crazy inflation, and this pervasive panic.
But then before any, big international bailout arrived, Ghana found a lifeline. Literally in the ground.
Gold.
Gold. And here's where it gets really, really interesting. How one sort of simple on the surface policy change just ignited this whole chain reaction.
What was the change?
The Mahama government, they asked this almost dangerous question. What if we stop pricing our own resources in someone else's money? Like US dollars.
A fundamental shift.
Huge shift. And they didn't just ask, they acted. They brought in this bold resource-based currency policy.
Yeah.
And the core of it, it became law.
Law. Okay.
Yeah, law. That all local gold buyers, didn't matter if they were domestic refiners or foreign exporters, they had to buy the gold in Ghanaian cedis, not dollars.
Wow. Okay. So no more dollar transactions for local gold purchases, period.
Period. It wasn't a polite suggestion. It was legally binding. And the impact was immediate.
I bet. What happened?
Well, straight away, it forced foreign companies needing Ghana's gold to go out and buy cedis, exchange their dollars.
Creating demand.
Exactly. Strengthening the cedis almost overnight. But there were other effects too, right?
Well, yes. That sounds like a really clever move, almost audacious. But were there concerns, like about pushback from those foreign companies or messing with international trade norms?
That's a fair point. And yeah, the sources suggest there were probably some initial grumbles, some friction.
Understandable.
But the sheer momentum and frankly the profit motive seemed to quickly overshadow that because this policy did something else crucial.
Which was?
It massively boosted the Bank of Ghana's gold reserves. They shot up from just 9 tons to, get this, 31 tons in only 18 months.
That's a huge jump in reserves, real assets backing the currency.
Precisely. And psychologically, it rebranded the Cedi. It wasn't this weak, flimsy thing anymore. It was, linked to gold, tangible backing.
And the timing. The timing couldn't have been better, could it?
Unbelievably good timing. Just as Ghana does this, global gold prices start soaring. We're talking $2,000 an ounce early 2024, up to $3,400 by May 2025.
Wow. Driven by all those global recession fears, geopolitical instability.
Right. So suddenly Ghana becomes this playground for gold investors. And if you wanted Ghana's gold,
You had to get Cedis. There was no way around it.
no way around it.
What's fascinating here, I think, is how Ghana didn't, go cap in hand asking for sympathy. They actively leveraged their own sovereign assets, gold, to create organic demand for their currency.
That's the key word, organic. This wasn't artificial support. It was real market demand, turning the Cedi into, as one source put it, a ticket to profit for international traders.
And you really saw that explode in the exchange rates by Q2 2025.
Oh, yeah, visibly. Leading to this, what the analysis calls commodity-driven currency discipline. They didn't just sell gold. They used the gold trade to remonetize their own currency.
Fundamentally re-anchoring its value.
Yeah.
It's quite brilliant strategically.
It really is. But, okay, gold brings credibility. It brings some fiscal breathing room.
But credibility is, well, it's notoriously volatile, isn't it? You have to defend it.
Spot on. It needs constant defense. So how did the Bank of Ghana, the BOOD, step up to protect that newfound strength? because gold alone wouldn't fix inflation, for instance.
Right. So the boog steps into the spotlight here.
Yeah, the Bank of Ghana, they'd been pretty reactive before, kind of constrained. But now with the CDs stronger and reserves swelling, they saw this window, a narrow one, high stakes.
To really go after inflation.
Exactly, to wage war on inflation. And in March 2025, they made a seriously bold move.
The rate hike.
The rate hike.
Yeah.
A full 100 basis points, 1%, bringing the policy rate to a steep 28%.
28%. That's high.
It's very high. And what really shocked the markets, apparently, was how they did it. No leaks, no warnings, just bang, a cold, calculated strike against price instability.
That says a powerful message, doesn't it? It signals Ghana's not playing defense anymore. They're on the offense against inflation.
Totally. And look, high interest rates hurt in the short term, right? Borrowing slows down,
Yeah.
credit tightens.
It stings, but it also rewards discipline. It tells banks, hold cash. It tells investors, be careful, calculate your risks. And it tells the world, Ghana is willing to actually feel pain to protect the value of its currency.
And the bog wasn't finished. They made another big shift. They abandoned their old system of, controlled Forex interventions, trying to manage the exchange rate behind the scenes.
And switch to
Spot market currency auctions, open, transparent auctions.
Okay. That's a profound shift. Moving away from managing perceptions, managing the rate artificially.
To trusting transparency. No more hidden dollar handouts to favored players. No more artificial caps. If you needed foreign currency, you had to bid for it. Publicly, honestly, at whatever the market rate was.
That must have had a huge impact on the black market, too.
Exactly. Our sources say it had this dual effect. First, it choked off that parallel market, the black market dollar hoarding, that had always weakened the cedi by creating this artificial scarcity.
Right, it brings everything out into the open market.
And second, it deepened the official Forex market's liquidity, making sure price movements reflected real supply and demand, not just, panic buying or speculation based on rumors.
That makes sense. But maybe the biggest win here was restoring trust, wasn't it? Not just for speculators, but for ordinary Ghanaians.
Absolutely crucial. People who'd seen their savings just evaporate in past crises. Suddenly, the cedi starts looking trustworthy again.
So people start holding on to it. Businesses start using it for contracts again.
Yes. That domestic confidence is vital. People held cedis instead of rushing to convert them. Businesses felt comfortable pricing things in cedis long term.
Providing that essential anchor.
But it's important to stress, this aggressive monetary policy, the rate hikes, the auction system, it was only really possible because Ghana had that cushion.
The gold inflows.
The gold-driven inflows gave them the buffer, and strong government messaging helped get public buy-in, even with the pain of high rates. It wasn't just a technical exercise. It was a masterclass in rebuilding confidence through decisive, sometimes unpredictable action.
Which really raises that interplay, doesn't it? Between a central bank's independence, its decisiveness, and its ability to actually inspire confidence both at home and internationally.
It really does. But even with that decisive monetary action, you can't just squeeze inflation with interest rates forever, right?
Well, you're absolutely right. It's like squeezing a balloon, like you said. Push down here, it bulges over there. Monetary policy alone isn't enough. Persistent inflation needs a deeper fix. You need fiscal backup.
Fiscal support, yeah.
Yeah.
You've got to tackle government spending, the balance of payments, the national debt mountain.
Otherwise, any gains from the central bank could just, poof, evaporate.
Exactly. And that's where the next piece comes in. The partnership with the International Monetary Fund, the IMF, Ghana approached them in late 2024.
But this wasn't like previous times, was it? It wasn't a desperate last resort cry for help.
No, that's a key distinction the sources make. This time it was framed as a strategic move, a partnership to support reforms that were already in motion. Ghana wasn't asking for a rescue. They needed time, trust, and crucially, that credible external validator.
An external stamp of approval, essentially.
And the result was this $3 billion extended credit facility, a 3-year deal.
Yeah.
But the emphasis, again, wasn't just the loan amount.
It was the discipline.
Discipline. So what did that look like? Well, some hard cuts.
Like what?
The government froze a massive 65 billion cedis in arrears payments. Outstanding bills.
Whoa. That sounds politically risky.
Hugely risky, but necessary to stop the bleeding from old contracts. Inflated invoices, you know the drill. Ministries, contractors, they were basically forced to re-verify claims, reset their expectations. No more easy money from the state coffers.
Okay, so plugging the leaks, what else?
But they went after borrowing costs aggressively. The IMF IMF-backed plan pushed Treasury bill yields way down from that sky-high 28% we mentioned down to 15%.
That's a big drop. What's the effect of that?
It rebalances the whole market. Before, banks could just lend risk-free to the government at crazy high rates. Why bother lending to businesses?
Right. It crowds out private investment.
Exactly. Slashing those T-bill yields forced banks to actually look towards, private enterprise, real investment, funding businesses instead of just funding the government deficit.
Shifting financial incentives, smart. And revenue. Was that part of the plan?
Oh, absolutely. Big focus on revenue mobilization. But not just raising tax rates across the board, it was smarter. Broadening the tax base, bringing more people and businesses into the formal system. Digitizing the Ghana Revenue Authority, making it more efficient. Cracking down harder on tax avoidance. Integrating reporting for small businesses. The goal was sort of normalizing tax. Making it a standard, expected part of economic life, not something to be dodged.
So fiscal consolidation on both the spending and revenue sides.
Right. But according to our sources, the real genius of this IMF deal wasn't just the technical stuff, the reforms themselves.
What was it then?
It was how Ghana used the deal. They used it to buy confidence in global markets. Investors who had been really nervous about Ghana's debt risk suddenly saw something different.
What did they see?
They saw a government owning the process, performing, not just, reluctantly ticking IMF boxes because they had to. They saw commitment.
And that perception shift had tangible results.
Immediate payoffs. Bond yields dropped further. Portfolio investments started trickling back in. Foreign direct investors, now reassured by that IMF stamp of approval, plus the government's actions, started scouting for actual opportunities on the ground.
Credit ratings improved.
Yep. Credit risk ratings got better. Even diaspora remittances, money sent home from Ghanaians abroad, started picking up again. People felt more confident about the country's direction.
But the most critical effect, surely, was the Cedi staying strong.
Absolutely. The Cedi held its ground. Not because the IMF was flooding the country with dollars. It wasn't primarily about the loan money. It stayed strong because the market believed in the plan.
Which really underscores how that external validation, when combined with genuine internal reform and commitment, can just amplify the positive effects. It gives investors the certainty they crave.
It's a powerful combination. So what does this all mean maybe for other nations grappling with similar challenges? Can they replicate this?
Well, before we get to that, there's one more crucial piece of this puzzle we need to talk about.
Yes, the political element.
Exactly, because none of this, the gold policy, the rate hikes, the tough IMF deal, none of it would have stuck, right? The whole recovery could have just unraveled without consistent political leadership.
That's such a critical point. You need the political will to see these painful reforms through. That's often the missing link.
And the sources point to Mahama's return to the presidency. Apparently, he came back at a moment of real national exhaustion. People were tired of the instability.
And he made a choice, or their choice maybe, to govern, as one source put it, like a grown-up.
Meaning
prioritizing predictability over, say, populist rhetoric or playing blame games. Focusing on steady implementation.
That's quite a contrast to what you sometimes see. So how did that grown-up governance actually manifest? What did he do specifically?
Several things stand out. First, he genuinely respected the Bank of Ghana's independence. Even when those 28% interest rates were surely angering parts of his political base, he let the BOG do its job.
Didn't interfere.
Well,
crucial for central bank credibility.
Absolutely. Second, he refused to shield politically connected contractors from that arrears freeze we talked about. No exceptions for friends of the government. That sent a strong signal about tackling corruption and waste.
Tough but fair.
Third, he allowed the technocrats, the experts, to actually lead the IMF program discussions and implementation. He didn't try to hijack it for political grandstanding or quick photo ops. He let them work.
Empowering the experts.
Yeah. And generally, his style was described as low-drama governance, which in a region sometimes prone to, reactionary populism or sudden authoritarian shifts, that calm predictability acted like a kind of strategic superpower.
Stability itself becomes an asset.
It really does. He also set a firm tone with Parliament, framing that fiscal restraint not as something foreigners were demanding, but as a national responsibility, something Ghana needed to do for itself.
Shifting the narrative internally and externally. How did his diplomacy help?
His international diplomacy was described as measured, consistent. It reinforced Ghana's credibility abroad because he spoke the language investors understand.
Which is?
Institutional continuity, regulatory predictability, the rule of law, basic stuff, but incredibly important for long-term confidence. He wasn't making wild promises. He was signaling stability.
And concrete actions, trade deals.
Yes, quietly negotiating new bilateral trade guarantees, opening up channels with energy partners in the Gulf, extending cooperation with West African neighbors, building bridges, reinforcing stability.
So all of this combined, it reassured investors that policies wouldn't just change overnight on a whim.
Exactly. Foreign investors felt more confident that export rules wouldn't suddenly flip. Domestic businesses could trust wage policies wouldn't be erratic. Citizens felt the government wouldn't just panic and reverse course to appease, say, import lobbies if things got tough.
That predictability is priceless.
Perhaps his most underrated contribution, though, was just restoring a sense of emotional stability. After years of turbulence, his grounded style, his non-politicized decisions, it helped calm the public psyche.
Rebuilding trust.
Re-earning the people's trust, which, as one source nicely put it, is truly the one currency no central bank can print.
That's a great line. And connecting this back to the bigger picture, it just hammers home how vital that political will and consistent, predictable governance are. They're the real anchors for any serious economic reform. They allow the policies, even the tough ones, to actually take root and eventually flourish.
Absolutely. So when you put all these pieces together, the gold strategy, the central bank's bold moves, the disciplined IMF partnership, and the steady political leadership.
It paints a clear picture.
Yeah, it becomes really clear that Ghana's success wasn't some fluke. It wasn't a speculative spike or just a lucky boom because gold prices went up. It wasn't a one-quarter wonder.
No, it was clearly the result of strategic alignment, decisions made across 4 crucial fronts, all working together.
It's like that phrase, a domino effect in reverse.
I like that. Instead of one thing knocking down the next, each move actually propped up the next one. Each actor, the government, the central bank, the IMF, international partners, they stayed in rhythm.
The order mattered. The connection mattered, not just the individual policies in isolation.
Precisely. It was the coordination.
And maybe the most astonishing part, or at least a key differentiator mentioned, is that Ghana stayed disciplined, even at the peak of the comeback.
That's rare. Often when things start looking up, the pressure comes off, right?
Exactly. Most turnarounds kind of fall apart during the recovery phase. Controls get loosened, people start celebrating too early, focus gets lost.
But Ghana didn't do that.
Apparently not. Both the government and the central bank kept this mindset of, we are not done yet. They maintained the discipline even when the Cedi was flying high.
That discipline at the peak, that's critical. It shows the commitment was real beyond just surviving the immediate crisis. It really demonstrates, doesn't it, how economic miracles aren't just about having resources or good policies on paper.
It's about the intelligent orchestration of them, the execution, the follow-through.
Yeah. So the Cedi, in the end, it's more than just a currency statistic now.
It feels like a signal, doesn't it? A signal that, yes, coordinated strategy can still work, that economic dignity can be restored.
And that countries, maybe especially in the global south, don't necessarily have to wait for external validation or follow someone else's playbook. They can chart their own path.
Own their resources, write their own strategy.
It's a powerful message.
It is. Now look, while Ghana's story is genuinely remarkable, we do have to acknowledge it's probably just the end of Act 1, right?
Realistically, yes. Risks definitely remain. Global markets are fickle. Oil prices could swing wildly. There are always elections on the horizon. Inflation is a beast that never truly sleeps.
One wrong move, one lapse in discipline, and progress could unwind scarily fast. Faster than it was built.
True, but
if the last couple of years have shown anything, is that Ghana knows how to fight. And maybe more importantly, it knows how to sequence that fight, how to be strategic.
with discipline as its core strength.
Discipline is its true strength.
Okay.
So that leads us to the final thought, the provocative question maybe.
Could this be a blueprint?
Yeah. Do you think Ghana's coordinated approach, the resource leverage, the monetary boldness, the fiscal discipline, the political stability, could it actually be a blueprint for other nations facing similar struggles?
Is this perhaps the start of a new era? An era of, let's say, economic self-determination or dignity for the global south, built on smart, coordinated internal strategy? That's the big question to ponder.